My name is David Clark. I'm the chair of the CFA Society in Scotland, and you're all very welcome to this event. My job is to preface our event here and to say it's proudly produced in Scotland. And of course, the CFA Society, the purpose of our society is to promote the interest of our profession and our clients. We have a distinct and vibrant industry in Scotland, particularly in the area of sustainability. And that's been long in place before this became the big talking point, long before COP26. So our event today is very much in that tradition. And if you're interested in what we're doing, please do reach out to us. I'm now going to hand over to the chair of our event today, David Hickey. David, please take it from here.
Thanks, David. Thanks for the intro. Very good. Welcome to all the attendees. I see people are still trickling in, but we will kick off right away. So quick introduction to the event. I called this Neo-colonialism in responsible investment practice. That title is willfully provocative because who doesn't like a little bit of clickbait? So thank you for those who fell for the clickbait and clicked and registered. But it's kind of covering what is a very, very serious topic in my view. I was asked to produce an event for COP26 on behalf of the Scottish group. And I said, no, I don't want to do a COP26 event because we'll end up with just another chat on net zero and climate. And to be honest, I've got nothing to add on that. But what we do have at CFA is a worldwide platform and the opportunity to look at something a little bit differently. Through my work in responsible investment, I am a portfolio manager and I'm the responsible investment lead at Lothian Pension Fund, a public sector pension fund in Scotland. During my work just recently, I've been noticing various trends and arguably mistakes that we're making as professionals, where we're not necessarily looking at the second and third order impacts of decisions that we're making as European investors. Most specifically through campaigning through our companies that we own to maybe divest certain assets without thinking about what the impact on local communities that divestment of those assets has. And through various discussions, we decided, you know what would be great? Let's actually get people together from markets that many of you won't have a lot of experience with. And, you know, the truth is, I certainly don't have a lot of experience in the markets that many of our speakers are from today. So I'm going to be sat here learning. I hope you as attendees are going to be sat here learning. We're going to open up with an introduction to each market. We're going to start east and work our way gradually westwards. That's going to take about 45 minutes as the participants, the presenters introduce their markets. I'm going to be scribbling questions throughout for the panelists, and then we're going to open up to questions after that, and hopefully get lots of questions from you, the attendees, and hopefully from the other panelists as well, and just have a good old discussion about what responsible investment practice means in the markets that our esteemed presenters are from. So with that overly long intro, I am going to hand over to our representative from CFA Society in Indonesia.
Thanks, David. Yeah, hi everyone. Look, so I think it's probably first wise for me to introduce Indonesia first. A lot of people haven't, particularly from Europe, a lot of people haven't gone to Indonesia. I myself, an Australian, I'm way next door to Indonesia here. As you know, you guys from England come to Australia, you probably fly over the top of Indonesia. It's a very important part here of Southeast Asia. if you think about Southeast Asia, Indonesia represents about half of the economy, of the economic activity in Southeast Asia. It's a $1 trillion economy. It's the 4th biggest country in the world in terms of population. So it's just behind the US. It's now sitting at around 270, 280 million people. It is big, it's diverse, it's over 17,000 islands in this archipelago that's spread across the equator down here. And it's what we'd like to call an advanced developing nation. And what that means is that it's got infrastructure now. There is rule of law. It's been a democracy now for around 20 years, give or take. And, like any fledgling democracy, it started as, something that looked like it might teeter over a few times. And it's now developed into the space now where it's now a full functioning, strong democracy, or much stronger than, and it looks like it's going to be enduring here as well. But as any developing country, as they work their way up the industrial learning curve, Indonesia's had its challenges as well. It's resource rich, so it means it's got oil, coal, lots and lots of pristine forests, many teak wood trees, these sorts of things. And so, and historically these things have been harvested and, done so in completely wrong ways. And on the flip side, and something that's more personal to me as a former banker who's now working in fintech here, doing, we're basically doing SME and MSME neo-banking for that digital SME sector here in Indonesia. And what we're doing is that we're trying to serve the unbanked and underbanked. Now, I mentioned before about Indonesia having, the population 270 odd million people here. Of those people, there's around 65 million MSMEs, so micro small businesses. And so, a micro small business could be somebody who's selling products on the e-commerce platforms. I'm not sure what the popular platform in the UK is nowadays, but so say like the local Amazon. It could be someone selling, products, cakes out of their lounge room, or could be somebody who's pushing a cart down the street. These are very small businesses, and traditionally they've been excluded from the investment industry here, and excluded from having access to capital and access to money. And so part of what we've done, and part of actually, I'll talk a little bit about the good first of the ESG criteria that's coming down, because in my sector of the world, it's actually mostly good. But then in the natural resources sector, there's actually, whilst I think overall it's good, I think there's some bad actions, and there's some kind of negative derivative things that have spawned out of it as well. And I'll talk anecdotally about those things as well. But so in my area and in my sector, what the regulations basically mean is that you can't lend to people who are on the OFAC list. We can't do industries that are bad and polluting. So, you're talking alcohol, tobacco, gambling. I think coal mining's on there as well. And anything that's exploiting children, and drift net fishing as well is one of the other things one of the other industries we can't lend into. And so for us, on the surface, that's fairly straightforward, because we're focusing on digitized businesses, and now pretty much every business, thanks to the advent of e-money, every business there is actually digitized now, because even the street card, you can walk up to the street card today and just pay using your handphone. Which is amazing. And we're kind of at this tipping point in history where cash is kind of dying out, especially here in the capital city. Out in the villages, it's still very much cash heavy. But so we're lending into that, and you'd think those sorts of exclusions wouldn't pose that much of a problem. But then if you think about some of those industries that we're excluded from are actually traditional family businesses in parts of Indonesia. If you drive through, so I'm on the island of Java, and for those who don't know Java, they probably recognize the word Java from their Starbucks. It's where a lot of the world's coffee comes from. It's one of the big, more popular thing. And so, have a cup of Java or, write some code in Java. But, but here in Java, in Eastern Java, if you drive along the streets, you see them drying tobacco on the side of the road. And you can actually get quite a good cigar too if you partake. But and it's not, we wouldn't be funding the big conglomerates because they don't need our money. But but we're also excluded from funding those smaller family businesses who are doing that niche business of making tobacco products into their local communities. They have a side hustle of growing some tobacco on their property, as well as the husband's off probably working their day job in the factory or whatever else, and then they're selling some cigars on the side and that sort of thing. So the regulations do exclude us from those businesses, which is something that happens. But overall for us, that's the negative. The positive for us overall is that now we're signed up to that, and we're so we have, and it's public knowledge, so I can disclose it. But so we have a European investor in us who's provided. First, they provided debt capital, and then they provided equity capital into us, and named Triodos Bank. So Triodos from the Netherlands, they're an impact bank. They've been excellent to work with. We're very lucky that we're their first globally their first fintech investment from their equity fund side, and that was all because when they made their debt investment, we actually then made some physical investment in terms of, okay, let's clean this up, let's see what's what, and through the back of that, we've actually managed to lower our cost of funding, which then gets passed into the community, and so we have that. We have those ESG regulations to thank in terms of coming in and helping us then access that European pool of capital. Off the back of that deal, we got another deal with another impact fund, and so that off the back of that impact fund, we then lowered our cost of capital even further. So as a business, it makes us more competitive here because we're doing things in the right way. If you probably go back 20, 25 years in Indonesia, maybe doing things in the right way, maybe not a competitive advantage. But because there's a system in place now, it does provide that competitive advantage for us because we now have that clean reputation for doing it. I want to spend just a couple of minutes also talking about some of the negative externalities that come out of this and probably aren't really imagined when they're being written. And I think that's probably the theme of today, of your lunchtime here today. And that's so for instance, I've had a career in Indonesia. I've worked, a lot of private equity type projects, and some in the impact space, some not in the impact space. But I was working on a oil and gas project once upon a time, and I was sitting in the office, and the family I represented were investing in this oil field, and the operations manager came into the CEO and said, "We have an NGO on site. They're demanding $30,000, and if we don't pay them, then we're going to get done under this regulation." And so you have that kind of that thing happen, and that's completely off the record, even though we're on recording. But that type of thing, it does happen. And then another externality that happens, and I'll probably finish up on this point because we can talk about more stuff. But another thing that happens too is that you have the carbon credit market, which is starting up here. And so one way that companies here can get carbon credit is by not doing something. And so what that means is that they can say, well, I'm very wealthy. I own all this natural land. I'm going to plan to build a golf course. And then if I don't build a golf course, I get the offset credits for not building a golf course on that land. What then can happen is that, okay, they have a nicely designed golf course for one piece of land in, say, Kalimantan, one of the other islands, and then that golf course can then end up being built, on a different island anyway. And so there is some of that gaming of the system that's coming in, but that's probably any system you have in the world, anything to do with money. People are always going to game and always going to try. They're always going to try to game, but it is. And overall, we can see that the IDX now has an ESG index. The Indonesian Stock Exchange, the IDX has a ESG index now, which is excellent for it. I know, having managed investment funds here before under an ESG mandate, yet there's about 60% of the market that's uninvestable. So that being said, you know, it's helping the country move in the right direction. So I'll end up there, and yeah, I'll pass back to David. Thanks, guys.
Mark, that was great. Thank you very much. Yeah, paying off NGOs is it doesn't surprise me, and you hear it. It's very unusual to hear of it being experienced firsthand. But loads of stuff to unpack there. But before we do, we're going to go around the other speakers. So I'm going to ask Asif to come on camera and introduce you to our speaker from Bangladesh.
Hi.
Hi, Asif. We can hear you.
David. Yes.
We can't see you, but that's fine if you're struggling with connection.
Am I not
There we
visible?
go. I can see you now. You're looking fabulous, sir.
Thank you very much. Thank you very much, David, and thank you, CFA Society of England, for arranging this fantastic event, and thank you very much to the participants for showing your interest to this interesting topic. So I'm talking from Bangladesh. It's actually situated in South Asia. Geographically, it's a delta in shape, and it has huge coastline in the southern part of this country. It has the highest population density in the world in a relatively small land. And for last more than a decade, Bangladesh is one of the fastest growing economies in the world, having average GDP growth of at least more than 7% a year. So what actually motivated Bangladesh in moved into sustainability? We have identified core three rationales behind the Bangladesh intervention in sustainability and ESG. One is propelling the potential of density dividend of the country and enhancing the resource efficiency of its relatively small land size, and addressing the climate vulnerability of the Bengal Delta in a more sustainable manner. We have different aspects of climate issues, climate disasters happening regularly in our country. So addressing these three reasons has been the core rationale for Bangladesh in moving into the sustainability and environmental social governance. So following these aspects, our banking sector, among the entire financial sector, moved into the sustainability horizon, having the core three philosophies. We have ingrained environmental sustainability and especially environmental social risk management to improve the credit management efficiency of the banks. We have consistently tried to transform the credit portfolio of the banks by diverting their brown assets to the green portion, not in full, but in partial aspect. And we have been operating number of refinancing lines to encourage the banks in moving their credit portfolio for diversifying their investment basket to actually reduce their risk and putting some impact on the environment. And how we are doing these things. So we have been consistently trying to build up a homegrown model of financial sector sustainability by having sustainable finance, including green finance in one line, environmental social risk management framework for the banks on their credit risk assessment, and moreover supporting the banks with financing lines. We are also keeping a cautious pace rather than moving fast in context of green swan risk theory or transition risk defined by BIS or European Union, because we still think that considering these issues in verbatim is not much appropriate for us at this moment. So we are trying to be a bit cautious we are learning this, assessing this risk, but we have not implementing these theories in cut-to-cut manner the way EU or World Bank has prescribed. And we have been persisting on developing our own ESG model rather than following the EU ESG principles or IFC performance standards. For an example, in 2011, we issued environmental risk management guidelines for banks, and we improved that guidelines into environmental social risk management in 2017. We have consulted the IFCPS or EU sustainability principles, but we have put our own standards and principles in that guideline by following the local environmental regulation and the local aspect, because our principle is not to hamper the growth of especially the small and medium enterprise. In our country, micro, small and medium enterprises are accounted for almost 35% of our economic growth a year. So if we push ESG at a very stricter level, their business may be hampered. This is our one of the core consideration. And in this case, in case of ESG, we have another strong footing. We also try to address the gender financing. We have rationing or quota for the banks in their lending activities for the women entrepreneurs, and moreover, we have dedicated refinancing lines for the small and medium women entrepreneurs. And we have some sustainability intervention from the fiscal aspect as well. Bangladesh formulated climate fiscal framework first time in the 2014, and at that time no other country in the world has its own climate fiscal framework. And following that framework, our government has been regularly doing climate budgeting each year. And apart from that, our other financial sector segments like capital market, they introduced the provision of impact investment in 2014 by issuing alternative investment rules. And following the experience of impact investment, our capital market regulator opened up the provision of green bond last year. And we have experienced the first ever green bond in our country this year, which was issued by a microfinance institutions to catalyze the climate facilitated microfinance on small finances. And moreover, we have also seen the issuance of first ever corporate green sukuk, which will be backed by the largest solar power project in our country. So in summation, in a brief or in summation, our priority is to use our resources in a more efficient manner, as our country is relatively small, and to address the growing need of the highly dense population of our country, and also to address the climate vulnerability of the country. So this is the opener from my part, and I will be happy to address any of the questions or queries from the audiences and the panelists as well. Thank you very much.
Super. Thanks so much, Azif. Your camera's coming in and out, but we're hearing you loud and clear. So that's great. Yeah, and there's again, there's an awful lot to unpack there. Now, who knew that Bangladesh was such a hotbed of ESG friendly investment opportunities for a start? And I certainly wasn't aware of that GDP growth rate. So yeah, loads to discuss there. I just quick note to the attendees. If you hear anything and you have a question on them, please drop it into the Q&A box at the bottom of the screen rather than the chat panel. I don't think anyone is using the chat panel at the moment, but just to let you know, and then we'll come around to those at the after these intro comments. Now I'm going to move on to CFA Society South Africa. Could you please introduce yourselves and take us through what's happening in South Africa, please?
Thank you, David. A great welcome and thank you from Daisy and myself, who the two of us representing South Africa. We're both board members of CFA Society South Africa in a volunteer capacity, and obviously have day jobs that are in different aspects of the finance industry. Well done on putting this topic on the table, and look forward, just in terms of this opening slot, I'm going to just get the audience briefed on just a little bit of the background in South Africa, assuming that not everybody's totally au fait. Hopefully you're aware of our good record in winning rugby and beating other teams and things like that, but perhaps not other elements of our country's assets, but also really putting a very realistic spin on the types of things that we face. So I'm going to share a couple of slides just so that I can do it quickly in terms of how we make our money, the level of employment, the income inequality in South Africa, and then just lastly on how we generate electricity, because I think very germane to this conversation. So here you go. Hopefully you see that. going to get a thumbs up. So just South Africa's GDP. I guess as you hopefully know, South Africa has a history of having been obviously as a country that had very severe segregation. We became a democracy in 1994 when the country was liberalized. And really, this is just how the economy is made up at the moment. The financial services sector actually dominates the sector, and I'll come to the next slide, which actually shows you how profits are made in the listed markets, which is slightly different, which is quite different from this picture. But unsurprisingly, you can see we wish we had Bangladesh's, eye-watering growth rates, but it's actually been a really challenging time for South Africa in terms of growth. And that's largely been the history of the fact that if you look at this slide, if the current listed companies, and this is really as a result of the commodity boom, we are still very much a commodity producing export nation. So there are about 160 listed companies on the South African stock market in terms of equities. Because of commodity prices right now, just under half those profits are actually sourced from resource companies. So notwithstanding the fact that financial services contributes the most to GDP, it's actually not representative necessarily of the listed equity market. South African asset owners, and we'll talk about this a bit more, are incredibly active in terms of ESG and responsible investing. But I guess we have some inherent constraints, and these are the kind of unintended consequences that one needs to really bear in mind as we pursue a responsible investing kind of, trajectory, which we all embrace, but they needs to be done in the context of our own country. So these are kind of the very sobering numbers for South Africa. So we have an actual population of over 50 million people, but in a population of over 15 to 64 of about just under 40 million. The labor force of that is just under 23 million. But we have, of that, only 14.9 million people that are employed, and 7.8 million people that are patently unemployed. So our unemployment rate is actually quite staggeringly over 34%. And you can see how that's trended on the right-hand side. And so this is a sobering reality that every one of us that invests in listed companies or private markets faces every day. If we wonder, how do we change this picture? We have to change the growth narrative. Quite worryingly, the unemployment rate among the youth, those that have finished school but are under 24, is way higher. So it's 6 out of 10 South Africans under 24 is unemployed, which is actually quite a desperate situation, as you can imagine. The other reality of South Africa is that we have a deep, intractable inequality. And this is a function of our history, which I alluded to earlier. And unfortunately, the last 5 to 7 years of democracy haven't quite fixed this at all, marginally improved it. So the World Bank obviously prints the Gini coefficients, and South Africa actually has the highest Gini coefficient. It's one of the most unequal, if not the most unequal country in the world based on the Gini coefficient. It maxes out in terms of the graph. If you go to the World Bank sites at 65 and we're at 63, we were at 65 not so long ago. In South Africa, the richest 10% own over 80% of the wealth. And in fact, just 0.1% of that owns 25. A more sobering number even is that the top 3,500 people in South Africa have more wealth than the bottom 32 million. And that just really gives you a sense of how deep the inequality really is. And then I guess the last point from me, which is when we start having a conversation about ESG, there's a big focus, obviously E, S, and G, but particularly with obviously COP26 in terms of climate change. But one needs to understand our status quo. So in South Africa, the status quo is that 86% of South Africa's electricity, and power generation comes from coal. So we have 58,000 megawatts of generation capacity in South Africa, and 49,000 of that comes from coal. And that's significantly higher than the global average of 34%. Mostly, also South Africa has actually got the highest reliance of all the G20 countries. So, and way ahead of the next member country, that's India. So those are just, and I guess what's interesting, so those are just a couple of points before I hand over to Deslin. But the reason I put that as a backdrop is that while our government has a clear plan, and we have been moving on this plan, for example, to reduce the dependency on coal over the next 10 to 30 years, so that 48,000 hopefully will be cut by at least half. The reality is the one that we face today, which is the GDP reality, which is the nature, we're the largest, for example, platinum producer and PGM metals producer in the world. The reality of our unemployment. So we're highly coal and energy intensive, and we have this economy that's characterized by high levels of inequality and poverty. So I guess in the long run, we know what we need to do in terms of sustainable growth and how money needs to be allocated. But it really, and is very dependent on transitioning away from a coal intensive energy system. But I guess with climate change being such a massive part of responsible investing, we have to look at it in the light, and the transition has to be looked at in the light of vulnerable workers and communities and really understanding the challenges of our country. And so we really have to, when we speak about the just transition, it's nowhere more real than in a country like South Africa. So planning to make this transition as just for workers and communities. And I guess at the same time, looking at the strategies we bring in really seek to mitigate some of the unintended consequences. So I'll end there and hand over to Deslen, who will talk you through some of those nuances.
Good afternoon, everyone. It's a pleasure to be here. My name is Deslen Naidu. I'm an investment practitioner and part-time academic at the Responsible Finance Initiative at the Gordon Institute of Business Science. And like South Africa, this introduction is a tale of two parts. Delphine has outlined the dichotomous nature of South Africa's society and economy. And alongside its modern cities exist large communities that struggle to have basic infrastructure. It has world-class universities, and yet it's failing to get students from schools that have very few amenities. It has mansions in Sandton that will rival anything on the global stage, and you have the poverty of the townships. Now, despite all of that, I think there's some significant things that are in favor of South Africa and Africa. I have, over the past few years, had the privilege of attending some of Singularity University summits that were held locally, and a large amount of them focused on future-proofing Africa. And 4IR and a number of exponential technologies can help Africa really leapfrog into more sustainable societies and resilient economies. In fact, if you look, we spoke a bit about the coal reliance. Across the globe, the Western and Northern Cape in South Africa hold some of the best sunlit areas geographically on the planet. And it's the size larger than England. And that's vast potential of renewable energy, not just for South Africa, but for its neighboring countries as well. I think South Africa and Africa on the whole is an impact investor's dream. So what I'm going to tell you a bit now is the journey around responsible investing, because responsible investing is not just a checklist, it's a system. And you need to understand that the investment is part of an ecosystem that's supporting the overall impact that you're seeking or outcome that you're seeking. So the formal journey on RI in SA started with the United Nations Principles of Responsible Investing in 2006. So in South Africa has 64 signatories at the moment, of which 17 actually signed pre-2010. Locally, we developed the Code of Responsible Investing for South Africa in 2011, which was a local framework to ensure that governance practiced within companies delivered both economic value as well as the environmental and social value. And it was one of the first globally. And it set a precedent where RI and ESG is engaged at multiple levels within our financial services ecosystem. It's even recognized as part of the practice guidelines in the pension fund regulation of South Africa, which means pension fund trustees have to adopt, it sets the basis for them to adopt these principles into their policy statements. Interestingly, when we look at South Africa, a large number of pension funds and consultants had expanded the pension fund framework into impact investments, including things like housing initiatives for its members, long before impact investing took off on the global stage. So on the backdrop of it, I suppose one would, South Africa, we actually saw that the country itself needed help in order to accelerate human development and the societal issues that were in play. So I'll step a little bit into what's happening on the asset management side. Asset managers have been using ESG and sustainability considerations in the security analysis for many, many years now. And proxy voting records have been for a larger part of the decade, although there's still quite a few that don't make them transparent. And we've seen active stewardship start to become far stronger. But company engagement has been slower to be adopted in this market. The reason I mention that is this behavior has a direct impact on our listed market. The more we have active shareholders, active stewardship and engagement, the better we expect the companies and their corporate behavior gets moved towards higher levels of standards. A few years back, we've had a few corporate failures like Steinhoff and Tongart, and this, I think, was largely the catalyst that made the investment community realize how important shareholder engagement would be around the G in the ESG, and a number of them have taken up the other environmental and social themes as well. In fact, my fellow panelist Delphine took arms against NASPAS together with 36 other investment managers against their shareholding structure and lack of management alignment. And these are the two largest companies listed on the JSE. And sadly, although that issue was not rectified, it raised the issue publicly. And I hope these representatives of shareholders continue to act until the changes are implemented. In our sort of bond space, and in particular the state-owned enterprise issuances, the same level of analysis and stringency as was sparse, but it was also a decade that was plagued by mismanagement of assets and corruption allegations, but very few bondholders and investors to hold them to account. But in 2016, Andrew Cantor, a fellow CFA charter holder, took an ethical stand against South African state-owned enterprises. He openly criticized the government structures and announced that the company he represents would stop buying the bonds of 6 of these issuers. Now, Andrew was recognized in 2018 by the Institute for the stand, and he's now become a champion for whistleblowing in the industry. The lessons of the past have shown whistleblowers have been threatened, ostracized, finding it difficult to get jobs, and some of them were even killed. But these are lessons that we build off to protect future whistleblowers. And again, I mention these things because of the ecosystem that I believe that must exist alongside a responsible investing framework. So for responsible investing to succeed, it's not just that checklist. I believe it's dynamic, it's resilient and steadfast alongside all of the other institutions that come into play. So hopefully the successes and failures amongst the various lessons that we've learned in South Africa become future business cases.
Thanks, Deslin. I'm gonna because I'm just watching time march on. I'm gonna come back to you later, and we'll follow up on some of those points. Okay. Especially, I like the bit about the denial of corporate bond funding. That's a subject that's very close to my heart, and one I'm always excited when I hear about it from other investors. So I'll probably ask you a question on that later. But we'll drop back. There's loads of questions in the Q&A session at the moment, so we'll come to those after our next speaker, who is representing CFA Society Nigeria. Over to you, Ibuka.
Thank you very much, David, and it's a pleasure to be here. I'm representing CFA Society Nigeria. I'm a sustainable finance and fintech professional, and I work in the Nigerian market. So Nigeria is certainly an interesting country. We have the highest population, the largest population on the African continent. And in terms of economic output, we actually lead the continent in that regard in terms of GDP. However, we also have the highest poverty levels on the continent. In fact, 7 million people fell into extreme poverty in 2020. And Nigeria is described as the poverty capital of the world. Our population is 219 million people. And of this number, about 93 million actually live below the global poverty line of less than $2 a day. So quite an interesting contrast, considering global capital flows. 3 out of 5 unicorns on the African continent are actually Nigerian entities. So we have InterSwitch, we have Flutterwave and Andela very recently. So it's quite a contrast. Our population mentioned earlier, 219 million, mostly young people. 43% of our population is between the ages of 0 and 14, and about 53% between the ages of 15 and 64. And this is largely the reason why we've had significantly lower COVID mortality rates. So that's something I have to bring in, because we're going to be looking at statistics pre-COVID and post-COVID. COVID has certainly resulted in significant drops in output levels and increased inequality, for us. And so of our population, of our total population, just less than 1% is fully vaccinated. And that's also something which is certainly, which would certainly be affecting economic output going forward. Looking at the subject, which is ESG, so I'll be diving into the finance areas now. And in terms of domestic resource mobilization, looking at funded pension assets to GDP ratios, Nigeria has about 7% funded pension assets to GDP ratio. The UK is about 108%, US 85%, Chile 80%, and Ghana 5%. So we run a defined contribution scheme nationally. And so it's actually backed, these are actually backed by assets, but the ratio is significantly low compared to other emerging countries and also developed countries. Post-COVID or during COVID, we've seen significant debt servicing costs. We certainly couldn't do QE the way America and the other developed markets have done. And our revenues have actually dropped off since then. We've seen a depreciation of the currency over 50% since COVID. And currently, Nigeria services debt with as much as 87% of revenue. And that's actually quite a challenge. And then putting this in the context of emissions, carbon emissions, historically, we've had emissions of about 2.5 billion tons. And how does this compare to the United States, which has had about 400 billion tons since 1850 up to 2010? The EU has had about 353 billion emissions, metric tons of emissions, while Nigeria has had just about 2.5 billion. So that's actually an indicator of the level of industrialization of the country. So our emissions as a percentage of global totals is actually less than 1%. However, the country continues to take significant steps to achieve the Sustainable Development Goals by 2030. The president ratified the Paris Climate Change Agreement in 2016, and Nigeria has also signed on to the nationally determined contributions. We pioneered the issuance of green bonds on the African continent, and that was in 2017, issued about $26 million, and followed up with the second issuance of about $37 million in 2019. And it's actually interesting to note that these notes are exempt from local taxes and also exempt from capital gains taxes. So other contexts relating to emissions per capita, Nigeria's emissions per capita is about 0.1 metric tons per capita. The United States, 16 metric tons per capita. South Africa, 8 metric tons per capita. The UK, 5 metric tons per capita. China, 7 metric tons per capita. And so that shows that there has to be some form of economic justice, considering the fact that we need to achieve some certain level of development in line with our carbon emissions targets. Looking at ESG, the Nigerian market, so I forgot to mention, the green bonds are actually quoted on the Nigerian Stock Exchange and also quoted with the bond market, FMDQ. And there's a prevalence in terms of ESG application in the country. There's a prevalence of negative screening because we try to meet up with thematic investing teams such as Islamic finance, and these are actually approved by the regulators. And so there's a preference not to invest in certain teams like companies in alcohol or in gaming and all of that. But we've not seen so much of positive screening or best-in-class screening, and that's certainly an opportunity for investors who try to internalize these externalities. A little more on the financial conditions. The Gini coefficient, which is a measure of inequality. Delphine mentioned earlier, South Africa is as high as 63%. We are slightly better. So our Gini coefficient is at 43.8 in 2021, and prior to that in 2018 was 35.1. So this is an indicator of the effect of COVID. So COVID has exacerbated the difference between those who have and those who don't have. This is also reflected in educational attainment. Most public schools were shut down during the lockdowns, while private schools and those who had access to digital tools could actually continue with work and continue with education. And we've also seen the impact. I mentioned earlier, less than 1% of the population is vaccinated. And so we're further divided into the jabs and the jab nots. And certainly Europe and other advanced countries have come up with these restrictions, travel restrictions, which severely affects our ability to be fully integrated with global markets. In terms of carbon pricing, there's no cost on carbon emissions right now. And so certainly that provides some form of regulatory, some form of arbitrage, carbon arbitrage opportunities for investors looking to take advantage of re-globalization efforts. So I would likely end here, and I look forward to questions. Thank you.
Ebuka, thank you very much for that. Wow, what I'm just learning and learning some more. So there's been a lot of information there. I'm going to ask all my panelists to come on camera if you can, as if we realize you may be having one or two problems with that. Okay, so first question from me, and this kind of ties into some of the questions I've seen here. In terms of ES and G, and this for those that don't know, that's the environmental, social, and governance pillars. For your markets, what is the most important of those pillars, and what do you deem to be the most important of the points that we've been through? I don't want to put any words in your mouth. I'm just trying to pull things together. Delphine, you're off mute. I'll go to you first.
Thanks, David. So I guess, this is obviously very shaped by my own opinions. And the question would be, when you say what's the most important for your market, how do you define market? And market would mean for your country and your economy and benefit to society. And then obviously for the listed companies, which are actually like this little cohort. We also have a very unusual situation that we have this highly concentrated index in South Africa. So the listed equities that the majority of retirement funds and investors invest in, just 20 odd shares account for 80% of that index. And as you know, over the last several years, just one share which invested in a Chinese, gaming company was like 25% of that. So when we talk about, we still feel, so if you talk about the listed universe, I would still say G is the most important element, but that's very contextualized, because I feel that in that sort of space, companies with good G, we've seen, tend to make good decisions about E and S. However, if we talk about our country, I'd say without a doubt, given the numbers that I put up, S is the most important thing in terms of how we need to prioritize it, and that the focus on E cannot be divorced and separated from how we take care of S in this decision. So it's two sides of the same coin. And obviously we've, Deslin's alluded to some of the governance issues we've had at a country level. So it's a little bit of a multifaceted answer because of the reality we face.
Yeah, I'm going to bring in Deslin on that now, because Ahmed in the chat box actually asked this or something related to this. And Deslin, I wondered if you could read or recap your answer to Ahmed for the purpose of those attendees that didn't see the chat box.
Yeah, so Ahmed asked the question, given our inequalities, shouldn't the emphasis be on S of the ESG rather than E? And I think the answer I started giving is that, unfortunately, E is dominating the narrative as the key agenda item on European agendas. So when that happens, people stop seeing the S element. So we know the societal elements due to inequality and the base effects of poverty. And if a country has to look at how to gear its resources, it needs to be at the S level. But to enable S, Delphine's absolutely correct, we need G. And that was the point I was trying to get to, is that the country needs to put a financial system, a legal system, an accountability system that protects investors, that will then allow the S to take shape. So we need a lot of initiatives in S. One of the things we don't see in terms of scoring metrics that come up is mining companies add a lot of societal benefits in South Africa. They provide homes for people in the mines. They provide social security benefits, which is completely absent in terms of the SA market. So if an improved impact would then just simply looking at EOS, I think it's the UN SDG framework, and if we can start measuring impact along that, we'd get to a far better state of understanding impact at both a global and localized level. And I think the last bit I've summed up with is that employment in itself drives societal gains and sets that sustainability. So SA not only can become carbon neutral, but carbon positive through a renewable program. And if the government's focusing on S, if investors and other DFAs can provide concessionary funding or mezzanine funding or even direct investment into these programs, it will develop both E and S simultaneously. The solutions can be integrated in many ways. Thanks for that, David.
Absolutely, Deslin. Yeah, and some of the things you mentioned there, I'm just going to plug one of my projects, which is the Talking Responsibly podcast. And we had Mark Cutifani on, CEO at Anglo American. Obviously, the splitting off of the Thungela resources from Anglos hits on a lot of the things that you talked about there, and that, mining is a very big supporter of communities and things, and for Europeans just to kind of demand that, we don't like thermal coal. There's one thing saying we don't like thermal coal, and another seeing that large multinational, well-run, well-governed company then just offloading assets. And I think that happens everywhere. And that was one of the things that kind of inspired me to do this event. I'm going to go across to Mark now, because I think it was in a follow-up to what Deslin was saying, kind of same question, but Deslin was talking about having those right institutions. You certainly talked about that in your piece.
Yeah, you know, and for us, in Indonesia, and whilst in my part of Indonesia, obviously the S is the most important, and I agree with Delphine as well. With the G, the E and the S tend to come along, but there's, from that perspective, there's already a lot of emphasis on the G coming from other various different parties. It doesn't have to necessarily come from Europe itself. And culturally, is that Indonesia has a, you know, like many countries, you know, it has its unique cultural nuances. So they do things their own way. And sometimes that clashes a little bit when you have a governance system imposed from above. So actually for Indonesia, the issue with Indonesia, it's 187 million square kilometers of forest. There are still literally native people living in the jungle in certain parts and on certain islands here in Indonesia. You know, we found, I'm in a big metropolitan city of 30 million people here, and I could jump on an aeroplane and within 3 hours I could be, you know, standing near a tribe here in Indonesia. And it's just, so the environmental part of that, and unfortunately those tribes are basically sitting on top of really valuable natural resources. And so, you know, so for us, I know it's sexy at the moment, and sometimes there's that negative reaction when something gets sexy, is that, you know, let's focus on the other bits. But environmental is definitely the most important thing here, because if something's not coming in, you know, there's lots of bad actors who can come in and take those resources. And we see every year with what happens with peat fires. Singapore every year gets complaints to Indonesia because they get polluted by the people burning forests for so they can clear land for plantations. But the joke is that Singapore complains once a year, but then they don't thank Indonesia for the other for the oxygen the other 11 months of the year that come out of the forests. But yeah, so, you know, so that, you know, environmental is definitely the most important one here, because it's here, and it actually, the carbon trading scheme, the cap and trade scheme actually represents a huge opportunity for Indonesia. And so, you know, the longer this system goes, the more, you know, the higher the carbon price goes, the more natural resources are then put towards it. You know, hopefully the better it comes, and hopefully they can save some of these pristine areas, because it's, you know, they do need saving. Yeah.
Yeah, I absolutely, Mark. And I'm going to go to Asif next, because I think that when I think natural capital, I think places like Indonesia with their beautiful pristine rainforest, and I think places like Bangladesh with the very important, probably one of the world's most important delta systems. So yes, same question to you, Asif. You know, the ES and G. What's the most important that you're seeing in Bangladesh?
Well, in context of Bangladesh, I feel like that our situation is more or less similar with what described by the Delphine. It's a multifaceted situation. Yes, governance is one of the most crucial factors, not in context of the good governance, but in context of the strong institutions. Both in context of the businesses, they must have the commitment and the capacity to understand an ENS situation and to implement it by having the business and the profitability at parallel. And moreover, the regulatory body and the government agencies must have the strong understanding of ENS integration into the businesses. So governance is definitely the most crucial factor in our country. But in second part, we have also another factor, because keeping the balance between the growth and the need of the sustainability. Whatever we say is that we should compromise the growth in sake of sustainability, but in practice, it actually really does not make sense, because inherently people think of their economic return at first, individual level. Each and every individual is cautious about their economic return. So we actually, from the policy level or from the business level, we cannot expect our consumers or the retail people will be responsible individually on the society. So strong governance and the institutions, keeping the strong having strong and institution and the governance system is the first challenge. And secondly, keeping the optimal balance between the growth and the environmental and social protection. For an example, in our country, we have the largest mangrove forest in our country, and we have the highest, the longest coastline. Thus, we have to innovate salinity resilient crops to produce in those areas of the country. So innovation, the right innovation in context of the every country situation and their demographic aspect will be really helpful to address this problem. Innovation is the key to overcome these challenges in many cases, and I think almost every cases, but keeping in mind of the understanding of the context of the country. For an example, I visited South Africa a few years back. They have the huge land area, relatively smaller population, but there are a high level of inequality. So innovation in South Africa will be one type, and innovation in Bangladesh will be another type. So we have to keep in mind that one size fit for all will not work in optimizing the ESG implementation. So these three things: innovation, governance, and keeping the right balance between growth and ESG implementation will be the key challenges. Thank you.
Thank you, Asif. Yeah, and I think the one size fits all will not work. I think that's something that we need to think more about from a European point of view, because we are, although in Europe we are many different countries, we are very similar. You know, there's not that much difference between the UK and Germany and France, for example, despite what our histories would like to tell us. Over to you now, Ibuka. I thought it was interesting that there's been a lot of talk about institutions. And I think the one worry of investors about investing in sub-Saharan Africa is weakness of institutions. So same question to you, and perhaps you could give us some color on what institutions are actually like in Nigeria, maybe issues around corruption, or maybe that there's less corruption than the UK press would have us believe. It'd be great to get that kind of info.
Yeah, thank you very much, David. Talking about the C word, I think in terms of institutionalized governance, Nigeria has done relatively well. A certain number of our companies are listed on the Johannesburg Stock Exchange and has to comply with those regulations. And that's certainly a pointer to the effectiveness of corporate governance. We also have Jumia, for example, is listed on the New York Stock Exchange. And so I think in terms of that, generally for most entities, they have governance frameworks and they try to work with them. I think the major area of focus for Nigeria, the major headwind, is in the area of the E. Nigeria is Africa's largest oil producer, an OPEC member, and certainly is affected by externalities which are actually beyond us. And so what happens in international oil markets certainly has a significant impact on all our macroeconomic indicators. So you find out that the oil price is almost the single largest determinant of everything else: interest rates, inflation, unemployment, and almost everything else. And that played out during COVID, with the lockdowns, loss of economic activity globally. We actually found out that, that kind of stalled economic activities also locally. And a deeply indebted government, would have to sell even more bonds to actually survive. And that's what's playing out. And so we are subjected to significantly high borrowing rates in the international markets. We just issued Euro bonds last week, I think $3.5 billion, and also courtesy of the IMF SDRs. We are hoping for some kind of breather. Our currency has significantly taken a hit, and because we are a largely import-dependent nation, this has also seen a rise in inflation, and that affects everyone. So I think in terms of the E, it's outside of our control, but certainly it's the major headwind that we face going forward. Certainly stress tests would need to be conducted on the impact on the financial system. Over 35% of our bank loan books is attributable to the oil and gas sector. And then you find out that the impacts of divestments, for example, Shell has experienced significant challenges in terms of the S in the Nigerian Delta. There are lawsuits. You talked about institutional frameworks. Yeah, in this regard, I'll probably agree with you. Most of these communities have actually had to get some form of justice internationally, not locally, but Shell is still bound by those commitments. And then you find out that Shell is trying to divest locally from onshore assets. And Nigeria recently passed the Petroleum Industry Act. We are hoping to reduce gas emissions and be able to list our national oil company, separate regulation from the players. And it's hoped that we'll be able to make significant progress with this, reduce gas flaring. But of course, a lot of this is still dependent on what happens in the international markets. With the tendency not to lend to projects in this sector, that would certainly almost rock our economic boat. So much, there's so much to look at, and I think the E is a very big factor for us. Thank you.
Yeah, I think that's a really difficult one, because I'd like to think of Europe has had we've had a lot of advantage from being first movers, especially in the UK. We talk industrial revolution, we're talking about the UK. And we've been able to use ignore externalities for 250 years of our economic development and not had to worry about this. Places like Nigeria, as you've said, I think you said 0.1 metric tons per capita of emissions, which is probably where the UK was, over 100 years ago. And then I find for us to then turn around and say, well, we're going to still operate oil in the North Sea, but you need to wean your fleshling economy off oil. I find it distasteful, to be brutally honest. In that vein, I'm going to go to Stephen Porter's question, and Stephen asks, if the old school definition of economic growth, i.e. GDP, is not sustainable and consistent with achieving an equitable and zero carbon economy, how do non-OECD countries achieve their desired human development? How do we, as global investors, help enable this where we need financial returns? So if you need to see that is in the Q&A box. Would anyone like to have a go at that one? Come off mute, just talk. Mark.
Yeah. So I'll actually talk just a little bit briefly, but so one of the things we do is actually education loans. And I don't know if it's a secret or a dirty secret, but in a lot of developing countries, and you're seeing the effect now in Indonesia with a lot of FDI pouring into the tech revolution here, with all the decacorns and unicorns coming out every day here. It's because the education system traditionally hasn't been very good. The education system here was one where once upon a time, every kid who went to a local school got 100% on their grade because that's what they got. And it was a family shame if they didn't. And so, so the local education system, not quite up to the standards where, I was lucky enough to have in Australia or you guys in the UK and maybe some other parts of the world. And so what that does to an economy like this is that now there's a real dearth of talent that's here and looking into these, as more and more money's coming in, they're really looking for things. And what we're seeing now is a real boom in wages as well. So wages are increasing, in my sector at least, kind of 20-25%, which I've never quite experienced it before in my lifetime. And it's just purely because there's not the talent here to take advantage of the opportunities that international investors are coming in and seeking. But the other thing being said now, though, is that because of COVID and because of this work from home, Zoom, whatever, we're having this conference call today from around the world, is that we're actually able to bring in foreign talents into Indonesia remotely. And so that's kind of helping lift the standards here and lift the way our company's operating. And hopefully the industry is doing likewise. And that, if you don't have the pool of talented people to make and do and provide the services and to create that economic activity, then you're never going to grow out of it. Like it's fundamental to everything is to have that good education system. The unfortunate thing of politics is that a good education system doesn't pay off for 20 years, but it's so important to have that. And yeah, so that's probably my 2 cents worth around that.
Anyone else want to weigh in on that?
Yeah, I'll just throw a few things in. Sorry, Delphine.
No, go for it.
GDP has been questioned in terms of, what exactly does it measure, and does it measure economic growth effectively? And I think it has its purpose, but it's also a little bit blinkered. There are different ways of measuring things. I do believe that what we need to achieve is figure out, where is human development going, and the UN has a Human Development Index, which sort of looks at a number of things like life expectancy and schooling and gross national income per capita, which is slightly different from GDP. And the view of looking at a balanced scorecard that's more appropriate for your particular country is probably the direction that needs to be that one needs to go. But people would say, if it's all different for different countries, how do you compare? And then therefore we cannot make decisions. So you sit in this dichotomous situation of what is standard versus what becomes specific. And I say the same way the UN SDGs allow each country to prioritize and set their development framework in specific ways. One needs to start contextualizing using both methods and not sticking with simply one. One provides holistic view, the other one provides context and depth.
I was just going to add a point on that last part of the question, which was how do global investors enable this? We focus on financial returns as well as social returns. And I guess one of the realities we're facing right now, and I guess it's probably true everywhere where there are investors and clients, particularly where those clients are large funds, is the funds are clearly focused on having the need to ensure that the target investments are meeting, a tick box of requirements, but they haven't yet, or we haven't yet seen it, haven't yet adapted mandates to actually include the elements of what that impact or what those social returns should be. So we're sitting in a slightly complicated situation if you're an investment manager, which many of the charter holders are, where you know that you must invest in assets which are meant to meet some sort of targets in terms of an ESG scenario, or at least not be terribly foul of an ESG scenario. But the overriding concern is one of the financial return. And so we're finding it we're in a tricky place. So I actually think that investors around the world, including in our own markets, need to sit down and actually embed some of the incentives and for changing behavior into their mandates. So they have to include impact elements, and they have to include what impact they want to measure, what impact they hope to see over a period of time. And it's particularly real for markets like ours, where we don't have large markets in terms of the number of shares. Our private markets are obviously massive, but they're very subscale in terms of the underlying companies. But we can't only solve impact only through the private market, opportunity set, which is very developmental. The public markets are very small, so very few shares. But so we can't just exclude whole tracts of companies, because there would be none to invest in terms of the listed element. We have to find mechanisms to work with those companies engaged to get them better. But if the only lens we're being measured is alpha versus some sort of benchmark, that's just going to incentivize that behavior.
Absolutely.
David, can I just add to this, please?
Sure.
So I didn't see the second part, I didn't read the full question. I'll just lean in on this to say that there are different types of investors. And we're not talking about utility theory. We're talking about those that are large enough to affect things at a system level, and then those where they are balancing off individual returns against a smaller savings pool. Now, large universal asset owners have a responsibility to ensure that the system itself reinforces the system they operate in. They tend to be very long-term investors. So sustainability, and so if you measure social return as part of that sustainability framework, then the balance between the long-term financial return and the relationship to the sustainability of the system are interlinked. And as such, systems level thinking and approach to how investments should be made is probably a more dominant theme for guys who are universal asset owners than the traditional asset managers. And that, I think, is the shift and trend that you're going to start seeing over the next couple of years within the market.
Fingers crossed. Asif, you got your hand up. You're on mute, mate.
Sorry.
No
Apart from the inputs from the earlier speakers, I just want to add on some few issues. For example, technology and evolving technology in the recent years have a big impact in calculating social return or the social cost. For example, social media, especially in last 4 or 5 years at the state level, different states are behaving or acting very differently in recent times against the big social media giants, that how they're impacting the social situation. And moreover, we are switching towards some technology. For example, blockchain is highly electricity consuming technology. So the developing or the small or low capital countries, whether they really need to use this technology or not, these debates should be stronger to address the issues of social return and social cost, the impact of social media and these technologies. Rather, we should promote homegrown, small scale, low cost, because these technologies actually impact at the societal level much more. In promoting the large tech issues, we miss the homegrown and the simple technologies in the remote rural villages. So responding to the answer, look, GDP, there are many criticisms of GDP, but it is inevitable that we cannot skip it, because financial return or economic return is a fundamental need of every individual. We are economic entity. Our first motive is the food, our well-being. So GDP cannot be skipped. So how we can add on the social cost or social return in the era of fourth industrial revolution or the social media, that would be a critical thing to consider for the policymakers and the businesses as well. Thank you.
Very good point. Right, I'm going to move on to another question, because I've got a question that I wanted to ask, and it's around the CFA UK ESG certificate. Now, CFA UK, as many people know, produced the ESG certificate as a follow-up to the investment management certificate, and we have coming out later in the year the climate investing certificate, which I was part of writing. And if we look at these certificates, they're a very UK-centric writing team and UK thought processes. And what we've done is CFA Institute has now taken the UK CFA ESG certificate, written by my mates in London. That's now a big international thing. Now, on the side of that, I look at the recent formation of the TNFD, the Task Force for Nature-Related Financial Disclosures. And I look at the people that are on that task force. We have a chair who is African, who is Elizabeth Marimba, who is the chair of the COP15 Biodiversity Summit. But then if you look at the task force members, they don't look anything like as diverse as this panel. And bearing in mind, this panel has 2 white guys on it. You know, there is a distinct lack of diversity. So what I want to do, I'm going to come to Abuka first. I'm going to ask, what are we doing wrong? How do we get more voices like yours into these conversations? What are we approaching badly? You can be as brutal as you want.
Okay, thank you very much, David. Yes, so in terms of sustainability standards, the taxonomy is largely defined internationally, and we kind of have to adapt it. We saw this with IFRS, for example. So we've had our local standards prior to now, but we actually have to comply with IFRS standards. And then recently, we're talking about International Sustainability Standards Board and a number of other taxonomies which are coming up. And to a large extent, we've not been able to have our own inputs. And I strongly believe that if there's an opportunity to actually turn the ESG risk, for example, into an ESG opportunity or an ESG alpha, certainly we are the people who should be in those conversations, because there's actually an opportunity with ESG. So for example, for Nigeria, there's an opportunity to invest sustainably. There's an opportunity, for example, to shift from cars to buses, to seek renewable energy sources. And these are actually opportunities for what I'll call ESG alpha. If you look at interest rates, for example, in developed economies, they're quite low, and they've been low for much longer. And so you find out that sovereign bonds of emerging and frontier markets are often oversubscribed. And with rising inflation in the developed markets, I don't know, but the real returns on these bonds would only get worse. And so look at the population dynamics, for example. Nigeria is estimated to be at least 300 million people by 2050. And so the growth is actually in our markets. The equity growth is actually in our markets. And so there's an opportunity to re-globalize. There's an opportunity to actually invest capital in where you get significant impact, social impact, in addition to financial return. I'll use an example of the most significant effects of climate change is its hydrological impact. And so climate change exacerbates floods and droughts. We have significant desertification in the northern part of Nigeria. And we also have very bad flooding and erosion in the southern part. And so, but these are actually investing opportunities. For example, not just looking at the national level, but also looking at the sub-national levels. There's an opportunity to be able to organize and actually put in some form of private equity investing, which in the long term, would actually bring about long-term duration returns, which would certainly beat the markets, beat developed markets, because these are what I'll call like almost guaranteed return investments. But it requires some form of organizing and putting in some form of effort and trying to make sense where there is no sense currently. But there's certainly an opportunity.
Absolutely.
And I think that's what should be looked at.
Yeah, Aaron Kalshka had asked about public development banks and stuff. Unfortunately, we're not going to have time to get to that question, so I apologize, Aaron. But yeah, that might be something for them. And it sounds like your answer is just Western investors need to educate themselves about places like Nigeria. So Delphine, same question to you, and we've got about 7 minutes, so I'm going to ask everyone to keep their responses to this fairly short, and we'll wrap up after this. So what are we doing wrong, and how do we get your voices in the room?
Yeah, fantastic question, and I would actually perhaps reframe it, or reframe the question, or how we pose it, which is, who is CFA Institute, and it's an organization of its members. Where are those members, and where's the growth coming from in that membership base? I mean, our CFA Society alone in South Africa is 2,000 members. But that's not small by any stroke of the imagination. I think the biggest growth is in China. We right up there in terms of the delta on where new candidates are coming from. And I would assume Africa is definitely going to be a source of it. So I almost feel as though the question should be, well, who are the current and future voices that we need to hear? Because these are going to be the ambassadors of these exact certificates. We are, the members are the ones that are basically promoting the certificate, promoting use of it, are basically the ambassadors or the mascots in their relative, region. So for me, it's almost, how can you not be including some of the biggest voices in terms of share of your membership, particularly in terms of the future? And I guess it's also just human nature. We kind of stick to whom we're familiar with. And so we sit, you know, I'm hoping the last 2 years have met, because of what today's made possible, means that we don't only have to meet at physical events and then get to know each other. And we've got I think the South African cohort to the annual CFA conference is typically the biggest cohort outside of the North Americans. But now so there's clearly a desire, but now we don't necessarily have those opportunities, but actually that should create more space for inclusion. There's currently, CFA diversity code that's being written, and it's entirely focused obviously on North America and Canada, but there absolutely should be. I mean, we are allowed as the different societies around the world to participate in the consultation paper rounds or in the exposure draft rounds, but I do firmly believe that we need to be included at the task team level. We started to see a bit of that in the ESG disclosure standards, so we did have a South African, but I know we send a lot of volunteers through with amazing CVs, but because they're not known in the groupings of who picks them, I guess it's just a function of affinity.
Yeah.
So yeah.
Yeah, great answer. Asif, anything to add?
No, apart from the Delphine and the speaker, two things that there's nothing wrong earlier time, but we should be more put more effort in raising awareness and earning technical skill on this issue among the societies and members. This is very important because there are a different contexts in different countries, but some standardized ESG understanding is very important. This is the first thing, because without having a common understanding, everybody will not talk about it and everybody will not adjust to these things. So like these events, the other societies should be encouraged, and more connectivity can be established to having more discussions. So if more discussion will be held, so more interest will be grown. So that will actually create the space and enthusiasm to talk on this issue, and then the critical things will come on board. Thank you very much.
Steve, it sounds like you're already pitching for a follow-up event to this, so we might touch base on that later. I'll go to Mark very quickly, and then Deslin, and then wrap up. Mark.
Yeah, I just probably want to spend a minute. There's a great question from Chris Miller here talking about, and try to maybe knock us off course a little bit, but talking about do we think
we've got 3 minutes, by the way, but.
Yeah, so to talk about the needs of how like SMEs and MSMEs in some of our developing countries, how they can be utilized in terms of implementing ESG. Obviously, there's not a hell of a lot of governance when it comes into a guy pushing a street cart, but in terms of the ES part, that they're major drivers there. And, the MSME part here is that it represents 97% of the workforce. And so if there's one lever you could really pull to do that, then it is doing that. But we do a lot of educational stuff, but it takes the owners to come in and actually learn and watch. And so, so answer the question very succinctly. Yes, hell yes, definitely. So, yeah.
Cool. Thanks. Deslin, last comments on what do we need to do more of?
Yeah, I suppose it's a two-way street. On the one front, you need to know that there are volunteers out there. And on the second front, volunteers need to know that there's a problem at hand. That means cooperation. As much as the societies are focusing locally, the sole local focus and not having that interaction is probably something that we're losing, and just forcing the institute to be the convener of that. So I would encourage intersocietal interaction, that each society has some member responsible for ensuring members can engage multiply and volunteer at different levels, so that you can start creating that diversity. Right. Passion will breed good outcomes.
Thanks for that, Deslin. And it sounds like that was a volunteering speech as well. So thanks for volunteering to help out. We have Monica Filkova on the call, who was part of the working group that built both the ESG certificate and the climate investing certificate, and continues to work on those. So Monica, I'm going to volunteer you all to speak to Monica at some point, and we'll see if we can utilize your skill set to broaden out perhaps edition 4 of the CFA ESG certificate. That's flown by. Monica says happy with that, happy to work with all of you. So there's a good outcome during the day. We get the right people in the room together, a global group of experts, a global audience. I'd like to thank you all again for giving your time, both this lunchtime, this evening, depending upon where you are. And thank you for everyone. I've really enjoyed it. I've learned a lot, and this video is going to be online at some point, and we'll be able to share it with you, with your societies, with your friends. Please like, please subscribe, please recommend, please share, all of those things. And I will leave you with a hearty thanks and a goodbye.